Welcome aboard to Cebu Pacific, Philippines' flagship low-cost carrier where turbulence is not an option, growing its aircraft in numbers to serve the increasing travel demand, driving a better shareholders' value. We in Group 1A Financial issue a buy recommendation for the stock with a target price of 55.01 pesos, a 66.69% premium from its October 27 closing price. The group believes that SEB is well placed to capitalize on the improved economic conditions and the resurgence of travel, potentially leading to favorable outcomes. With the efficient and consistent performance of SEB, we expect better financial performance. To be more concrete, this buy recommendation is supported by 1. A consistent gross profit margin driven by conservative revenue growth and manageable expenditure, which leads to 2. Slowly but steadily increasing trajectory of passenger sales as more aircraft are acquired, and 3. Cost management of direct expenses with fuel price reductions.
First, we see Cebu Pacific with a consistent GPM for a smooth journey, driven by conservative revenue growth and manageable expenditure. GPM, or the gross profit margin, is one of the major profitability ratios. The goal of this margin is to calculate the amount a company makes in relation to its direct costs by dividing gross profit with total revenue. In this case, gross profit is the total amount SEB's core business functions generate less direct expenses. Therefore, GPM is a rational basis for evaluating the company's efficiency. In 2018, SEB's GPM was 22.79% and increased to 36.55% by 2019. However, the favorable growth would unfortunately not be replicated for the succeeding 3 years, as the economy of not only the Philippines but the world would be disrupted by the pandemic. Social distancing and quarantine were the norm, and travel, specifically air travel, became an afterthought. This is actually reflected in SEB's income statement, as during 2020 to 2021, the company had negative margins of negative 6.52% and negative 36.10% respectively. When looking solely at the GPMs, SEB's actual recovery started during 2022, when it generated a lower but positive GPM. And based on the group's forecasted financial ratio analysis, this trend will continue as SEB first improves by a significant margin and then maintain their gross profit margins within the relevant range of 29 to 30% for the next 6 years, suggesting that efficiency and consistency can be expected when buying SEB stocks.
Secondly, slowly but steadily reaches the destination first as more aircraft are required to meet the increasing passenger sales in a post-pandemic market. According to the group's forecast, total revenue is expected to grow at a slow yet steady pace, with passenger sales as the main driver. From total revenues of 22.6 billion pesos in 2020 and 15.7 billion pesos in 2021. This could improve to 63.6 billion pesos by 2028. With the conservative approach, the recovery of SEB will be more about sustainable growth than gigantic leaps of financial figures. Passenger sales should still be at an upward trajectory, as seen below, and the overall performance of SEB compared to its pre-pandemic levels will be comparable while keeping adjustments for economic conditions and other variables in mind. Efficiency will be SEB's theme for the next 6 years and beyond as new fleet of Airbuses means new opportunities and avenues for revenue generation. The slow yet steady increase in total revenues is accompanied by the same trend on its cargo services and ancillary revenues. The primary driver, of course, is the passenger sales. However, with the increasing demand related to flight operations as post-pandemic trends are optimistic, we also see a conservative increase in its revenues to be generated from transport of goods as well as rebookings, refunds, cancellation fees, and others that are in support of air transportation as the primary activity.
Thirdly, we will now focus on cost management to weather through external risks with efficient control of direct expenses and reduction of fuel prices. In the second quarter of 2023, SEB had direct expenses, or expenses tied straight, to the creation of their services of 31.96 billion pesos. That's a 52.44% increase compared to the same period last year. Now, when we look closer, most of these expenses are related to flying operations, which went up by 57.6% to 16.77 billion pesos. This increase is mainly because more flights were happening and the company was expanding its operations as COVID-19 restrictions eased. They also used more fuel, which was about 71.4%. But this increase in fuel costs was balanced out by a drop in the average fuel price. In terms of how expenses relate to revenue, the company managed things more efficiently. In the second quarter of 2022, expenses were 101.37% of revenue. But in the same period in 2023, it decreased to 73.38%. Now, despite the big increase in expenses, the gross profit margin jumped from negative 1.37% to a solid 26.62% in the same period. This positive change is thanks to a 110.58% increase in revenue. Looking ahead, the forecasts for SEB expect a small 1.04% increase in expenses yearly, with GPM staying pretty stable, growing by an average of 29.16% each year. We're being conservative and aiming for efficiency, considering things like the return to pre-COVID-19 flight levels, new aircraft, and controlling costs for fuel, labor, and maintenance. We're also keeping an eye on factors like airport capacity, supplier relationships, technological advancements, and possible fuel price changes.
With our optimistic outlook on SEB's future revenues, we forecast the corporation to have increasing liquidity over the years, heavily driven by increases in cash and cash equivalents as business operations continue to ramp up. In line with this, we also forecast their currently negative net working capital to turn positive by 2028. These, along with decreasing days payable over the next 5 years, could help cultivate a good relationship with SEB suppliers and help match SEB's bargaining power with their suppliers' bargaining power. On the other hand, according to their plans of acquiring more aircrafts and other non-current assets, SEB's PPE and right-of-use assets are projected to grow yearly by 16% and 3% respectively, leading to increases in debt in order to finance these asset acquisitions. Although these would increase depreciation and interest expenses in the short term, SEB's further investments to expand their operating capacity would boost revenues in the long run.
To compare the valuations used, presented is a football field chart constructed with a sensitivity analysis accounting for the changes in WACC, cost of equity, and multiples. With SEB not declaring and paying dividends in the past 3 years, DDM is not used. However, FCFE is chosen as the main method as it best takes into account majority of the changes in the financial statement, mainly the net borrowing, hence resulting in a more accurate stock valuation. To arrive at the target price using FCFE, the cost of equity is computed by multiplying 7.89% by the 0.82 beta, which is then added to the risk-free rate resulting to 13.41%, which is used with the 2% growth rate, enough to account for SEB's growth in the coming years due to high flight demand. Graphed here is the target price of 55.01 pesos from FCFE and the freeze price of 33 pesos. This yielded a 66.69% upside, which is greater than 10%, hence the buy recommendation.
We identified 3 major investment risks. First is the supply chain issue of the lack of available aircraft parts from closures of engine manufacturers. With an improving economy, this risk can be minimized by re-evaluating their suppliers. Airplanes currently run on jet fuel, a finite resource. With inflation, costs will naturally increase, so price adjustments would be the feasible solution. SEB also officially announced that it plans to purchase Airbuses with $45 billion. This comes with the risk of limited capacity. However, there are new airport projects that, when built, can house SEB's new fleet.
In conclusion, the group stays firm on the buy recommendation due to the following reasons. First is SEB's constant GPM. Second is SEB's ability to meet future passenger sales through aircraft acquisition. Lastly is because of SEB's efficient cost control and with the reduction of fuel prices. Here are our references. That is all. Thank you, and we hope you were enlightened in this flight.